Why refinancing might be on your mind in 2025. As 2025 approaches, many homeowners nearing retirement are asking the same question. Is it the right time to refinance? With rising interest rates and inflation impacting household budgets, the decision to refinance can feel more urgent than ever. Locking in a lower rate could mean saving on monthly payments, freeing up much-needed cash for retirement expenses. But with the economy in flux, making the wrong move could leave you paying more in the long run. Refinancing could be a smart way to reduce your mortgage payments, pay off your loan faster, or even tap into your home's equity. But is it the right move for you? In this video, we'll break down the pros and cons, helping you understand how current economic factors could affect your decision. Stick around as we dive into the key steps of the refinancing process and how to evaluate if it aligns with your retirement plans. Understanding mortgage refinancing in simple terms. Refinancing your mortgage means replacing your current home loan with a new one. It's like hitting the reset button on your mortgage, and it can offer some benefits, especially if you're nearing retirement. One of the main reasons people refinance is to get a lower interest rate. This can lower your monthly payment and save you money in the long run. Another reason to refinance is to change the terms of your loan. You might want to switch from a 30-year mortgage to a 15-year one to pay off your home faster. Or maybe you want to extend your loan to lower your monthly payments, which can be helpful if you're on a fixed income in retirement. Then there's cash-out refinancing, where you take out a new loan for more than what you currently owe and pocket the difference. This could be useful if you need cash for big expenses, like home repairs or medical bills, but it also increases your loan balance. Now, refinancing isn't free. You'll need to pay closing costs, which include things like appraisal fees and title insurance. These costs can add up, so it's important to weigh them against the potential savings. It's not just about lowering your interest rate. You'll need to factor in how long you plan to stay in your home to see if refinancing makes sense. Timing is key when it comes to refinancing, especially with interest rates constantly changing. Rates in 2025 could look different from what they are today, so knowing when to refinance can make a big difference in how much you save. In the next section, we'll dive into when it might be the right time to refinance. Timing matters. Is 2025 a good year to refinance? Timing is everything when it comes to refinancing your mortgage, and 2025 could present some interesting opportunities. Interest rates go up and down based on the economy, and right now, experts are watching closely to see where things are headed. If rates stay low, refinancing could help you lock in a better deal, saving you money each month. But if rates start to rise, waiting too long could mean missing out on those lower rates. For retirees or those nearing retirement, the timing of refinancing is especially important. A lower monthly payment can free up extra cash for other expenses, which is a big deal if you're living on a fixed income. On the flip side, refinancing too late, when rates have gone up, could leave you with a higher payment than you wanted. So, it's all about keeping an eye on interest rates and knowing when to make your move. The economic outlook for 2025 will play a huge role in this. If inflation slows down and the economy stabilizes, we might see lower rates. That could be a perfect time to refinance, especially if your current rate is higher than what's available. However, if inflation continues to push rates up, refinancing might become less attractive. For retirees, it's not just about what's happening in the market, though. You'll also need to consider your own financial picture. If you're planning to retire soon, lowering your mortgage payments can help stretch your retirement income further. Pros of refinancing. Before retirement, how it could benefit you. Refinancing before retirement can offer several benefits that might make a big difference in your financial future. One of the biggest perks is the potential to lower your monthly mortgage payments. By securing a lower interest rate, you could see a noticeable drop in what you owe each month. For someone on a fixed income, that extra breathing room can go a long way, giving you more flexibility to cover everyday expenses or unexpected costs that come with retirement. Another benefit is the chance to save on interest over the life of your loan. If you can lock in a lower rate, you'll pay less in interest, which means more money stays in your pocket. This can add up to significant savings, especially if you plan to stay in your home for many years. For those who want to speed things up, refinancing can also help shorten your mortgage term. Switching from a 30-year to a 15-year loan, for example, might increase your monthly payments slightly, but it can save you thousands in interest in the long run. Plus, owning your home outright sooner means you'll have one less bill to worry about in retirement. Refinancing can also free up some extra cash through cash-out refinancing. This option allows you to take out a new loan for more than you owe and use the difference to cover retirement expenses like medical bills or home improvements. It's a way to tap into the equity you've built without having to sell your home. However, refinancing isn't for everyone, and there are some potential downsides to consider. In the next section, we'll explore the cons of refinancing so you can weigh whether it's the right move for your retirement plans. Cons of refinancing, the potential drawbacks. You need to know. Refinancing before retirement might sound like a good idea, but it's important to understand the potential downsides too. One of the first things to consider is the cost. Refinancing isn't free. You'll need to pay closing fees, which can include things like appraisal costs, title insurance, and loan origination fees. These fees can add up quickly, sometimes running into the thousands. If the savings you'd get from refinancing aren't enough to cover those costs, it may not be worth it in the long run. Another downside is the risk of extending your mortgage term. If you refinance into a new 30-year loan, you might lower your monthly payment, but you're also resetting the clock on your mortgage. This means you could be paying for your home well into retirement, which might not be ideal if your goal is to become debt-free sooner. There's also the potential impact on your cash flow. While refinancing can lower your monthly payments, it might also stretch out your debt, leaving you with more interest to pay over time. And if you're considering cash-out refinancing, you'll be adding to your loan balance. This might give you some extra cash in the short term, but it could leave you with higher payments or less equity in your home down the road. So, while refinancing can offer some clear benefits, it's not always the best solution for everyone. You'll need to weigh these costs and risks carefully to see if refinancing truly fits into your retirement plans. Now that we've looked at the potential downsides, let's walk through the refinancing process itself. Knowing what to expect can help you decide whether it's the right move for your situation. The process of refinancing. Step-by-step guide for 2025. Refinancing your mortgage might seem complicated, but it's really just a step-by-step process. The first step is to evaluate your current mortgage. Look at your interest rate, monthly payments, and the total amount you'll pay over the life of the loan. Ask yourself if refinancing could save you money or help you meet your retirement goals. Next, it's time to research lenders. Different lenders offer different rates and terms, so it's important to shop around. Compare interest rates, fees, and loan options. Some lenders might have special programs for retirees or those nearing retirement, so it's worth asking about those as well. Once you've found a lender with an offer that works for you, the next step is to apply. This involves filling out an application and providing the necessary documentation, like proof of income, tax returns, and information about your current mortgage. The lender will also run a credit check to assess your creditworthiness. After you apply, the lender will order an appraisal of your home to determine its current value. This is a key part of the process, as the amount you can borrow depends on your home's equity. Once the appraisal is complete and everything checks out, the lender will approve your loan. Finally, you'll move on to closing. This is where you'll sign the final paperwork, pay any closing costs, and officially finalize the new loan. After closing, your old mortgage is paid off, and your new one takes its place. With the refinancing process complete, it's time to think about how this fits into your long-term retirement planning. In the next section, we'll explore how refinancing can play a role in setting yourself up for a secure financial future. How refinancing fits into your long-term retirement plan. Refinancing your mortgage can play a key role in your retirement planning by helping you manage your income and expenses more effectively. For many retirees, lowering monthly mortgage payments through refinancing can provide some much-needed breathing room, especially if you're living on a fixed income. By reducing your biggest monthly expense, you'll have more flexibility to cover things like healthcare, travel, or simply maintaining your current lifestyle without feeling stretched financially. That said, it's important to think about the long-term effects of refinancing. While lowering payments can help in the short term, extending your mortgage term could mean carrying debt further into retirement. Some people prefer the peace of mind that comes with being mortgage-free before they retire. If your goal is to own your home outright, refinancing to shorten the term of your loan might be a smarter move. This way, you can pay off the loan faster and enjoy debt-free living during your retirement years. On the other hand, if freeing up cash flow is your priority, refinancing to reduce monthly payments or doing a cash-out refinance could give you extra money to put toward other retirement goals. For instance, the money saved on monthly payments could be used to boost your retirement savings or to cover unexpected medical bills. It's all about balancing what makes sense for your specific situation. If you're concerned about having enough income in retirement, lowering your mortgage payments can give you more room to breathe. If you're more focused on eliminating debt, paying off your mortgage early might be the better path. Next, we'll take a closer look at how refinancing can increase your financial flexibility, helping you free up income for other important retirement needs. Refinancing to free up income for retirement. Refinancing can be a great way to free up extra income during retirement, allowing you to use that money for things that matter most. For instance, some retirees choose to put the savings from lower mortgage payments toward their retirement investments, helping their nest egg grow over time. Others might use the freed up income to cover healthcare costs, which can become a bigger concern as we age. Take Linda, for example. She refinanced her mortgage to lower her payments by a few $100s a month. With that extra cash, she was able to travel more frequently, fulfilling her dream of seeing new places while still comfortably managing her day-to-day expenses. Then there's Robert, who opted for a cash-out refinance. He used the extra funds to pay off lingering medical bills, giving him peace of mind as he entered retirement without that burden hanging over his head. It allowed him to focus on enjoying his retirement rather than worrying about debt. These examples show how refinancing can offer financial flexibility, whether you want to grow your savings, manage healthcare costs, or simply enjoy life a little more. But it's not the perfect solution for everyone. Deciding if refinancing is right for you in 2025, key factors to consider. Deciding if refinancing is the right move for you in 2025 depends on a few key factors. First, consider your age and where you are in your retirement planning. If you're still several years away from retirement, refinancing to lower your payments might give you extra income to put toward other financial goals, like boosting your savings or investing in your health. On the other hand, if you're closer to retirement, you might prefer the peace of mind that comes from paying off your mortgage faster, even if it means slightly higher payments for now. Next, think about your financial goals. Are you looking to free up cash to cover retirement expenses, or is eliminating debt your top priority? If having a mortgage in retirement doesn't bother you, lowering your payments can make life more comfortable. But if you want to enter retirement debt-free, refinancing to shorten your loan term could help you achieve that goal. You'll also want to look at how much time is left on your current mortgage. If you're only a few years away from paying it off, refinancing might not save you much in the long run. But if you have 10 or more years left, refinancing could significantly reduce your interest costs or monthly payments. Finally, consider your retirement timeline. If you plan to retire soon, lowering your mortgage payment could help stretch your retirement income further. If you're already retired, make sure refinancing won't extend your debt too far into the future. Exploring alternatives to refinancing before retirement. If refinancing doesn't seem like the best fit, there are other options retirees can consider. One option is a home equity loan, which allows you to borrow against the value of your home without refinancing your entire mortgage. This can be useful if you need extra cash for a large expense, but want to keep your current mortgage terms. Another alternative is a reverse mortgage, which lets you access the equity in your home while deferring repayment until you sell the home or pass away. This can provide regular income during retirement, but comes with its own risks and costs, so it's important to understand the details before committing. Some retirees choose to downsize instead. Selling your current home and moving to a smaller, more affordable property can free up a significant amount of cash and reduce your monthly housing costs. Plus, a smaller home often means lower maintenance and utility bills. Each option has its pros and cons, and the right choice depends on your personal situation and financial goals. Real-world case study: a retiree's refinancing journey in 2025. Meet Susan, a 65-year-old retiree living in her family home. With 15 years left on her mortgage, she's debating whether refinancing in 2025 would help her manage her retirement finances more effectively. Susan's main goals are to reduce her monthly expenses and free up more income for travel and healthcare. She considered refinancing to lower her payments, but after crunching the numbers, she realized that extending her mortgage could push her debt well into her 80s. While the lower payments were tempting, she didn't like the idea of carrying a mortgage so late into retirement. Next, she looked at a home equity loan to cover an upcoming roof repair. This option allowed her to tap into her home's equity without changing her current mortgage terms. However, Susan decided against it because it added more debt, which didn't align with her goal of reducing financial obligations. In the end, Susan chose to downsize. By selling her home and moving to a smaller, more affordable property, she eliminated her mortgage completely and had extra cash for her retirement goals. Susan's decision shows how weighing options carefully can lead to a solution that fits both your financial goals and retirement timeline. Now, let's wrap up with some final thoughts on making the best decision for your future. Making the best choice for your future. The key takeaway here is that refinancing your mortgage is a personal decision, especially as you approach retirement. It's important to evaluate your financial goals, home equity, and retirement timeline carefully. What works for one person may not be the best choice for another. Consulting with a financial advisor can help you make a well-informed decision based on your unique circumstances. Thanks so much for watching. If you found this video helpful, don't forget to subscribe for more tips on financial planning and retirement. We've got plenty more advice coming your way to help you make smart choices for your future. See you in the next video.